Welcome back, family, to another installment of the Wealthy Wallet Wall Street course. This is installment number 4. And please, before we get started, do not forget to hit that subscribe, like, or follow button if you find this information to be very valuable to you and if it's helping you trade or become a better trader in the stock market. Class 4, we're going to talk about indicators. What are indicators? In order to understand what indicators are, I want to make sure we are on the same page when we're talking about indicators. So I want to give you the definition, Webster's definition of what indicators are. The Webster definition says a thing, especially a trend or fact that indicates the state of or level of something. That indicates the state or level. So it's like an apparatus, a tool, something that can measure the current state or level of something. So what is an indicator? It's a tool, it's the instrument, it's a thing that we use to measure a trend or a fact that indicates the state or a level of something. Indicators. We use them in our everyday life. Have you ever walked into a room or into a situation where you felt that it was a little off or something might be wrong? Well, your feelings were indicating to you that something is up. You might not know exactly what it is or have the knowledge of what's up, but your feelings are indicating to you that something's wrong. Something could possibly go wrong. Your feelings are an indicator. And not only are your feelings are indicators, there's so many devices that you use in your everyday life to indicate stuff to you. Your thermostat in your house is an indicator. It tells you whether the temperature is 80 degrees or 60 degrees. When you driving to work or getting in your car or going on a road trip or something, you have a gas indicator, and you know automatically when that orange light comes on, that indicates to you that you are about to run out of gas. That's an indicator. Just like there are indicators that we use in our everyday life, there are also indicators in the stock market that can help us make better decisions or better choices when deciding to invest into a stock. So, what are market indicators? Market indicators are quantitative in nature and seek to interpret stock or financial index data in an attempt to forecast market moves. Market indicators are a subset of technical indicators and are typically comprised of formulas and ratios. So, in general term, market indicators are instruments that are used to help you predict the move of a specific stock. It helps you predict the future price of a specific stock. So, indicators help you to forecast in the future where a stock might go, whether it might go up or whether it might go down. So again, market indicators are instruments or tools used in the stock market to help you calculate the future price of a stock. It helps you to be able to forecast or predict the future move of a stock, whether that move is up or whether that move is down. So if these market indicators can help us to predict or forecast a market move or stock movement, then we probably need to know about these indicators. We probably need to learn or gain the knowledge, because with the knowledge of market indicators, it helps us to understand when we should jump in a stock, because the indicators tell us that the stock is going to make a huge market move, or it tells us not to jump in a stock because the indicators or the instruments that indicates to us that a stock might be falling to the floor, right? So it's very imperative that we gain understanding of market indicators. So I want to start out with the first market indicator. We call it the simple moving average. So what is a simple moving average? A simple moving average calculates the average of a selected range of prices, usually closing prices, by the number of periods in that range. What do you mean? So, for example, this is how you would calculate the simple moving average of a security or a stock with the following closing prices over a 15-day period, right? So, what I mean by closing prices, the stock market closes every day at 4 p.m. and after hours go to about 8 p.m. But the stock market closes at 4 p.m. Eastern Standard Time or 1 p.m. Pacific Standard Time. But most people are on the East Coast, so I always like to put it to East Coast time. But so let's just say the stock XYZ stock was at $20 on day one when the market closed at 4 p.m. That stock got to $20, right? And then on day two, right, the stock got to $22. XYZ stock went to $22 when the stock market closed at 4 p.m. And then on day three, it went to $24 when the stock market closed at 4 p.m. And on day four, it went to $25. And then on day three, when the stock market closed, the stock was at $23. This is exactly what it means. And then so on and so forth as we go to week two and then week three. But in order to calculate a simple moving average, you have to add all 15 of these days up. So you would add 20 plus 22 plus 24 plus 25 plus 23 plus 26 plus 28 plus 26 plus 29 plus 27 plus 28 plus 30 plus 27 plus 29 plus 28. That will equal out to 392, right? And then you take that 392 because you have added all 3 weeks up. You have added all 15 days up, right? 15 days of closing prices. If you added all 3 weeks up, all 15 days, you would get 392. And then you divide that 392 by the time period, which is 15 days. So I would divide 392 by 15 because I took a 15-day moving average. I took 15 days in order to calculate this moving average. That's where I get the number 15 because that's the time period or the period in which I'm using to determine the simple moving average. So I would take all these numbers and I would divide them by, after adding them up, I would divide them by 15. And then when you divide it by 15, you get $26.13. So I know that the simple moving average of this stock over a 15-day period is $26.13. So if XYZ stock is at $22.32 right now, and I know that the simple moving average, the 15-day simple moving average is $26.13, then I know without a shadow of a doubt that I'm probably going to jump in this stock because the daily average of the stock is at $26. And right now it's at $22. First, I'm going to go look. Why is this stock at $22? Oh, there was an offering. But we'll talk more about offerings and other things in another class. But let's just say there were no bad news. There were really no bad news that caused this stock to go down to $22.32. You don't see any bad news after you Google, and after you look up the stock on Yahoo Finance, you looked up everywhere, you saw no bad news, but all of a sudden the stock's at $22.32, but you just did your calculation that showed you that the simple moving average, that means over a period of 15 days, this stock is at $26.13. But right now it's at $22.32. So to me, this stock is on sale. So I'm going to jump right in it because I know this stock is in a sucker free zone. Its daily average is $26.13. But right now it's at $22.32 and there's no bad news nowhere. So why would I not jump into this stock? And I know without a shadow of a doubt that this is going back to $26. I know this is going back to $26 because the simple moving average tells me this stock is trading below its simple moving average. That's why you should always use indicators as an instrument to tell you where you should jump in a stock at. This is perfect to jump in. It's at $22.32. But let's say the same stock was at $30.50, right? Then we got to understand, why is it way above the simple moving average? Why is it above? Is it some good news come out? Did they introduce a new product? Did a bank give it a new price target? Why did the stock just move up like this? And you got to find out why it just moved, because you could potentially overbuy the stock, because you know that the simple moving average is $26, but you're about to jump in at $30, right? So if you jump in at $30 and tomorrow the stock goes back down to 26, 27, then it's your fault for not doing your homework. You should have known that when you jumped in, the stock was overbought and no good news came out. But if good news came out that's going to continue to make the stock grow, you know, $30 is going to, you're going to jump in and you're going to run it up some more, because the good news, you know, that you want to know and understand that the good news made the stock go from 26.13 to $30.50. You know that. So then you completely understand that the simple moving average helps you to make a decision to whether not trade or trade, to jump in or not jump in, or to know at least where you're jumping in. Because if you know that the moving average is $26, right? You know that the simple moving average is $26, you'll know what the median point is to get into the stock. So you'll know that it's a good buy at $23. It might not be such a good buy at $29. Why? Because it's trading above its simple moving average. Do your due diligence and always calculate at least a 10-day moving average. I calculate 10, 20, 50, and 200. That's what I do. I calculate 10-day moving average, a 20-day moving average, a 50-day moving average, and a 200-day moving average, because I want to know the points in which I'm entering the stock. Is it a good buy or not a good buy? And simple moving average will help you to determine that. So use that instrument, that indicator, as like your means to know how high or how low you're buying the stock, to know the value of the stock. If the value is $26.13 currently, then I know if I buy it at $22, I'm buying it below its value. But if the stock is currently at $30.50, and I know that its moving average is at $26, I'm buying it above its current value. That's why you need to understand a simple moving average. But let's move on to the next one. So, what is the exponential moving average? Well, the exponential moving average is a technical chart indicator that tracks the price of an investment, like a stock or commodity, over time. The EMA exponential moving average is a type of weighted moving average that gives more weighting or importance to recent price data. Like the simple moving average, the exponential moving average is used to see price trends over time. So what the exponential moving average is designed to improve on the ideal of a simple moving average by giving more weight to the most recent price data, which is considered to be more relevant than the old data. Since the new data carries greater weight, the EMA responds more quickly to price changes than the SMA. So basically, the exponential moving average is basically the SMA, which is the simple moving average with weighted volume to it. So it adds a little bit more to it. So it adds more fluctuation to it. So if the exponential moving average says, if the simple moving average is $26.17, and then the exponential moving average says, let's take a look at all this data and see the trend and what's in it, and let's add that weight of trend to it. Let's add that extra weight to it, because this is the weight that it continues to pump up over these 15-day period. So let's add that actual weight to it, because that's going to give me a better statistic of where this stock, this is going to give me a better analysis of where this stock is going to be. So let me add that extra weight to it, because I know that this stock at least moves 0.5% on a daily basis. During this average, it's going to move 0.5%. So let me do that 26, and let me add that 0.5% to it. Let me add this extra weight of this 5 point. It's actually a mathematical equation. I just don't want to fully go into it with you. And it's easy. It's just a simple, easy look up. You can go on Investopedia and look up how to calculate exponential moving average. That's a long equation, and this is not a math class, so I don't want to go on with it forever. I just showed you the simple moving average is because it's something easily you can calculate right off your phone. I don't want you to get too entangled into exponential moving average, because those are indicators that are able to calculate that for you. But I do love to do math, but I just don't want to do long math for you on this particular. I just rather you go look it up yourself and add the indicator to whatever you're trading, whether you're using Yahoo Finance. And again, you can add all these indicators on Yahoo Finance charts. If you don't actually have, I use TD Ameritrade Think and Swim app to add all these things to me. I mean, Robinhood doesn't have it, but you can definitely use Yahoo Finance and you can add these onto your charts so that you'll know when a stock is overbought or undersold. That way you overbought or oversold. I'm sorry, overbought or oversold. That way you'll know if you're getting in it above value or below value. You need to know these things, but the only way you know these things is based upon these indicators. So again, the exponential moving average is designed to improve on a simple moving average. It just adds a little bit more weight to the simple moving average by calculating the previous data and adding the extra weight that needs to be applied to it other than just the actual closing prices. It adds the weighted volume to it. And that's what a simple moving average is. So, but let's move on to another one of my favorite indicators. So, what is relative strength index? What is RSI? RSI, what is the relative strength index? The relative strength index is a momentum indicator used in technical analysis that measures the magnitude of recent price changes to evaluate overbought or oversold conditions in the price of a stock or other assets. The RSI is displayed as an oscillator, a line graph that moves between two extremes and can have a reading from 0 to 100. The RSI will rise as the number and size of positive closes increase, and it will fall as the number and size of losses increase. For example, when there's an uptrend in a stock, the RSI is likely much higher than the 30% level, and when a stock is in a downtrend, the RSI is much lower than the 70% level. So what do you mean, Donnie? What do you mean? In order to fully explain what I mean, I have to literally show you on a line. I have to literally show you on a graph. So let's take a look at Tesla on the graph. Let's take a look at the RSI on the graph. Let me just maximize this real quick. So let's take a look on the graph. So if we look at Tesla today trading, right? We look at Tesla during the hours it was open. We look at Tesla, not in the aftermarket. Boom. We look at Tesla. Okay, right here is the RSI. This is the RSI right here. This is the RSI. So the RSI, when Tesla floats open, told me, boom, people were trying to oversell the stock. They were overselling the stock. Look, because it dropped all the way far, it dropped too far down. It went all the way to 40. Remember, really oversold stocks go below 30. So I know this stock was at 70 when it opened, which was in perfect alignment. It was okay to stay in that stock. And then it dropped significantly to 40, right? So the RSI lost 30 points in minutes. So in 5 minutes. So this showed me that people were overselling the stock. And since people were overselling it, buyers said this is a buying opportunity. Let me jump in, right? And they jumped in right around here. So look, the stock opened up at 859, right? They wanted to push to 860. And then boom, right before this 5-minute candlestick closed, this mug went all the way down to 852. So it lets us know that it opened up at 859 and dropped to 852. $8 just dropped off. Boom, gone. It's gone. So it let me know people were overselling the stock. And since they were overselling, the buyer says, this is a buying opportunity. Let me jump back in because it's almost at the rock bottom, right? So people, boom. And then you see throughout the day, it was oversold again. It dropped all the way down to 837. So if you're a trader and you're watching this, you see the RSI drops below 30, right? Then you might be thinking it might be a good time to get into this. But how do you know you should get in it? And then this is where our other indicators are going to show us it's time to jump in. But before we jump in, I just want you to understand what relative strength index is. So the momentum of the stock is on a downtrend, right? And this downtrend is now telling us that the stock is actually being oversold. It shouldn't continue to be going down. It's literally being oversold. Too many people are selling. The stock shouldn't be losing this much value that quickly. So since the stock should not be losing that much value this quickly, then people are good traders look at it as a buying opportunity. So they jump in it. And you see when they jump in it, they're like, man, 837, what a hell of a buying opportunity this is. People are as oversold this is oversold. So man, it's time to jump in right here. And then when you jump in, look, it correlates with each other very perfectly. Look, it dropped down as oversold, right? This is where a good trader would jump in at because oversold value. And I'm gonna show you why a good trader would jump in at this after you learn the other indicators. But let's go over the RSI first. So you jump in right here on RSI because it's oversold. And look, boom, it rides all the way back up to where to go. Rides all the way back up to 850. So a $13 move quick, right? $13 move in about an hour. Took a $13 move in about 1 hour. So, but the RSI tells us exactly. And then boom, look, this mug almost touched 70, right? And when it touches 70, it tells us that this stock is about to be overbought. Too many people are buying it, are jumping in and then chasing the run up. So people are probably going to start profit taking and selling. So it probably should get out because this is overbought. And look at exactly what it did. It went far. I'm going to show you why I did this. But last week we learned support and resistance, right? This is the resistance up here. A couple of weeks ago, no, last week we learned support and resistance. If you were in that class, you understand what resistance is. And resistance tells us that this stock didn't break the bubble, and the RSI is telling us it's being overbought, and then it keeps trying to break resistance, but it doesn't go through. So it lets me know that this stock is at its height. So it's time to punch out. So what I do, I punch out because I don't want to ride the wave down. Look, and then once it kept trying to break resistance, kept trying, and once it was not unable to hold resistance, it turned down to being oversold again, boom, and again. And when you jump into stock down here and you know that it's not going to go any farther past support, then you're going to jump in on a good ratio. You got to know where support is, though, right? Because once you know where support is, you knew that this was a good spot to buy because this is not support. It's just being oversold, right? And last week we learned about support and resistance. So if you didn't watch that video last week, I suggest you go back and watch the videos last week where I talked about candlesticks control the narrative. It'll teach you about support and resistance because you definitely need to know where support and resistance is in a stock, you know so that way these indicators make more actual sense to you. So it's definitely very imperative that you go and watch last week class or make really start from the very beginning of the first class so that you begin understanding, because all this information is going to come together. It's going to make you a super trader when you understand how all of this works and how all these indicators and candlesticks, how they all come together to help you make a well-informed decision. You'll definitely understand it better. So, but this definitely helps me understand. Right before the market closed, this thing started to go right back up, right? And the RSI has turned from going in a downward trend into an upward trend. So the momentum is turning around. I know that since this stock opened at about almost at 860, I know it's going to retest it tomorrow, and I know it might go past 860 tomorrow, and that's what I'm hoping because I actually jumped into it. Well, I know you'll get this video on Saturday, but this is what today? I don't even know what today is. It's today is Wednesday or Thursday, I think, but it's Wednesday. But when you see it, but by the time y'all listen to this video, you'll see that the RSI is telling me that this stock is on the move back up, and right now it's at 851, and it closed at around 851 after dropping down to 848. That lets me know, the RSI lets me know that I'm okay. But RSI always helps you to be able to trade the momentum. And if it's an oversold momentum, you probably should not jump in. But if it's an oversold momentum, if you know where to get in at and that the stock has not fallen below support, then this is a good buy, right? A real good buy. It's a real good opportunity for you to make plenty of money. But if you know that the stock is at resistance and it won't go past and it's in the overbought level, which is above 70, right? The overbought level is above 70. The oversold level is above 30. So if it's above 70, be very cautious, because this stock could literally jump out the window at any given time. That's why you have to be very cautious when you jump in when a stock is overbought. So when it's above 70, that means it's overbought. And when it's below 30, that means it's oversold. And if it's over 30 and you see it's oversold, but it did not go past support, then it's time to jump in that stock because you're going to ride that baby back up. Same thing with the 70 when it's oversold and it hasn't broke the resistance yet, or if it even broke the resistance and it's oversold, it could continue to go. But why is it going like this? Why did it jump up? Why did it go at being overbought? What's making the stock run up? You got to know those things, because if it's just running up based upon momentum, then you're going to be hurt because the stock is literally going to jump out the window, and you don't want to be hurt because the stock is going to jump out the window, right? So you want to know exactly where to get in at. Getting in at 50 is pretty good, but getting in at 50 good, but getting in at 30 and it did not break support is even better. So understand where you're jumping in at, and the RSI help us to understand the trending momentum of the stock. All right. I don't want to overload your brains. So we're going to stop here. And then next week, we're going to go into class 5. We're going to start off talking about the moving average convergence, divergence, the moving average convergence, divergence. So I definitely don't want to overload your mind. But definitely go ahead and add those indicators, whether you're going to do it on Yahoo Finance or or if you use Think and Swim like me, which is from TD Ameritrade, or any chart using app. Definitely add these indicators. We talked about the RSI, the EMA, and the SMA. So add the Sipping Moving Average or the EMA and the RSI, the Relative Strength Index. Make sure you add these applications to your trading charts. That way you begin to know when to jump in and jump out, and you start to get familiar with how they look and how they operate and how they work. Please, if you found this information valuable, don't forget to like or subscribe or follow, whether it's on Instagram, whether you saw this video on Instagram, YouTube, or Facebook. Just make sure you hit subscribe, follow, or like if you find this information to be very valuable to you. Again, I'll see you next week, family, and I hope you had a wonderful time with me.